Hello, and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. I'm Tom Evans, a private equity M&A partner in Latham & Watkins' London office. In this episode, we discuss how, amid increasing foreign direct investment screening regimes, deal teams have opportunities to capitalise on newly available exemptions, but must also beware of novel complexities. I'm joined today by a fellow partner from the London office, Jonathan Parker, who specialises in antitrust and foreign investment. Jonathan's also the former Director of Mergers at the UK Competition and Markets Authority. Thank you for joining us, Jonathan.
Thanks, Tom. Glad to be here.
I'm very keen to talk about the piece that you co-authored in Latham & Watkins' PE Views, which was titled Foreign Investment Controls. Are we seeing a more nuanced approach to private equity? Before we get into nuance, why are we talking about foreign investment controls, Jonathan?
FDI is a hot topic globally at the moment, Tom, and there's been a huge increase in FDI activity over the last 12 months or so. To give you a whistle-stop tour of some of the recent activity, in the US, the reforms to the CFIUS regime took effect earlier this year, introducing mandatory filing requirements for certain transactions involving critical technologies. In the EU, the transitional period under the FDI screening regulation came to an end in October this year, meaning that member states and the European Commission will now formally cooperate on FDI, including sharing information and expressing concerns. At the member state level, there's been a noticeable acceleration of the implementation of national FDI regimes, and the European Commission has recommended that all member states introduce an FDI screening mechanism if they don't already have one. At last count, I think 16 member states were reported to have FDI screening mechanisms in place, with a further 7 member states with measures pending. Outside the EU, the UK has recently announced a new FDI regime, and countries with pre-existing FDI regimes, like Australia and New Zealand, have become significantly stricter, mostly as a result of the COVID pandemic. Overall, this area has become increasingly topical, particularly given the political rhetoric over the last few months about trade wars. Now, to track all of this activity, we have a Latham & Watkins app that monitors the FDI rules in a range of different countries and is regularly updated to capture changes to existing rules.
Sweet. Where can we get the app?
Well, my kids downloaded it at the App Store, Tom, but I believe it's also available at Google Play, and the link to both of these locations is on the Latham & Watkins website.
Splendid. So if you had to, you mentioned a couple of jurisdictions, but if you had to give your top 3 for FDI at the moment, Jonathan, what would those be?
Well, there are numerous current hotspots, and one of the reasons for the app is that FDI approvals are now much like merger control. It's important to undertake a jurisdictional analysis to see what filings are triggered around the globe. But if I had to highlight 3, then I would probably pick, in no particular order, number 1, the UK. With the introduction of the National Security and Investment Bill, there's been a root and branch change to national security reviews in the UK, with a move to a largely mandatory regime and an expected enormous uptick in the number of filings that are likely to be required. Number 2, Australia. Changes to the FIRB regime this year and the removal of the value thresholds have resulted in a focus on Australia in a transactional setting that I haven't seen in the last 20 years, with a huge increase in the number of FIRB filings being made and the changes that came into effect on the 1st of January 2021 to counteract some of these changes. And number 3, the US, simply because it's such a significant and active regime. The fact that mandatory filings were introduced earlier this year is a big change. And the fact that there's going to be a change of administration potentially brings with it changes to the US's approach to inward investment and perhaps a period of uncertainty in relation to the new administration's approach.
Interesting. And thanks very much, JP. I know you're a lawyer, so it's always difficult to provide only 3 examples when you ask for 3. If you had the opportunity for a 4th jurisdiction, what would that be?
Probably Germany, which has been a real leader in Europe on FDI reviews over the last few years. It's very active. It has mandatory filings as well as the ability for parties to make voluntary filings. And just given the size and the importance of its economy, it's an FDI regime that's frequently relevant to transactions.
Brilliant. And then, so if we can just head back to the FDI bill that you mentioned in the UK, significant root and branch change, you said. What transactions are caught and how long is it going to take for those transactions to clear?
So the single biggest change in the UK is that mandatory notifications will be required for acquisitions in 17 specified sectors, the definitions of which are currently subject to a public consultation process, but which include areas that you would expect to find in national security legislation, such as civil nuclear, defence, military and dual-use equipment, and satellite and space technologies, but also include areas such as artificial intelligence, communications, computing hardware, and transport. There are no revenue or asset thresholds in relation to these acquisitions. It's only necessary that the target entity carries on activities in the UK or supplies goods or services to customers in the UK.
JP, just on that one, does that mean that you don't even need a UK subsidiary to be subject to these filing requirements?
That's correct. No UK subsidiaries needed. So the mandatory filings will be triggered when you cross various shareholding thresholds starting at 15% and then 25%, 50% and 70%. And in addition to the mandatory notification regime, the business secretary will also have the power to call in transactions that fall outside these 17 specified sectors. And merging parties are also going to be able to make, for non-mandatory notifications, the 15% threshold won't apply, but specified shareholding thresholds of 25, 50 and 75% will apply. In relation to your point on timing, there's a slight difference depending on whether the transaction qualifies for a mandatory notification or is called in by the business secretary. But for mandatory notifications, there's an initial 30 working day screening period during which it's anticipated that the large majority of transactions will be cleared. This will be followed by a 30 working day review period for transactions that require a closer assessment, and this period can be extended by a further 45 working days.
And will there be a pre-notification period as well, JP, that you'd put on the front of that?
I think in practice, there probably will be. Our discussions with BEIS have suggested that's not absolutely essential. They have put out questions that parties should fill in as part of the notification form, and they are relatively straightforward. But I think in practice, what parties will probably do is answer the questions, fill in the form, and provide this to BEIS to ensure that they consider the notice to be complete before starting the screening period.
So moving back to the increase in foreign direct investment restrictions at a global level, how do we manage that risk on deals?
Well, I think there are different categories of risk that we need to think about. In relation to target risk, which is perhaps the most important, due diligence will clearly be important. Bottoming out the target structure on a global basis, identifying where the target has revenues, assets, subsidiaries, but also identifying any activities in sensitive areas and recognizing that those sensitive areas may vary by jurisdiction, identifying government contracts, and also identifying other more nebulous areas where there might be a reason for potential government intervention. There's also investor risk, and this is largely a matter of investor origin. Clearly, investors from potentially hostile states will raise the most issues, but overall, I think we're seeing a trend of increasing focus on sovereign wealth funds, foreign government investors, and looking in more detail at LP structures to see who is investing in particular transactions. There's also contractual risk, and I think FDI is generally moving in the direction of the type of risk structuring that we're familiar with in relation to merger control filings, with more of a focus on how to deal with risk allocation between parties in conditions to closing. We're also starting to see the inclusion of break fees.
So finally, the nuance that you mentioned in the title to your PE View articles, what's the answer? Are we seeing any nuance?
I think overall it's a bit of a mixed bag. I mean, generally speaking, most FDI regimes recognize that the large majority of investors don't raise national security concerns, and that these concerns are only likely to be raised by investors from a small number of potentially hostile states. But FDI regimes around the world have approached the issue of how to filter for these more sensitive transactions in different ways. And there's been a clear trend towards mandatory notifications for a wide range of transactions falling within designated sectors of the economy, with a number of countries widening their jurisdictional lens to ensure they capture all of these transactions. But there's also been some adjustment to jurisdictional focus in other jurisdictions. So in the US, We've seen changes to CFIUS to allow a review of certain types of investments by LP investors and minority investments by co-investors. In Australia, where there's long been a focus on foreign government investors, and the changes that were made to the FIRB regime from the 1st of January 2021, including exemptions to some of the FGI rules and a return to some of the normal value thresholds. And in the UK, the likely approach of the government under the new regime will be to require more information regarding LP investors and about different types of investment structures than has been the case in the past. But the draft legislation currently working its way through Parliament also gives the Secretary of State the ability to provide for exemptions for certain types of investors. And we'll need to watch this space very carefully to see how this develops over the coming years.
It's been a pleasure speaking with you, Jonathan, and thanks very much for joining me today.
Thank you.
Thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else that you listen to podcasts. If you'd like more information about the topics in this podcast, please email us from links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.